three most common assets that I'm seeing being used by the STR owner operator. It's really three loan products. Now, there's going to be the Fannie Mae second home mortgage. Within those guidelines, it does allow for that property to be leased out on a short-term basis. That is written in their guidelines. Now, with the Fannie Mae second home mortgage, your down payment requirement is going to be 10%. That's what we'll talk about, maybe put it in pros and cons. Fannie Mae second home mortgage, 10% down. You're going to have a lower rate than you would on some of these alternative investor loan products, okay? And then you also have no prepayment penalty. Most of these other alternative investor loan products are going to have some version of a prepayment penalty on them. So with the Fannie Mae product, you don't. That's an advantage. Now, a disadvantage to the Fannie Mae second home mortgage is it's going to be a full income doc underwriting, meaning we're going to look at, your tax returns, pay stubs, W-2s, etc., in order to qualify you for that loan. And we have to be able to income qualify, meaning your debt as compared to your income cannot be greater than 45% on that type of loan. So, and then you cannot close in an LLC on that type of loan. So if you're an investor that has intentions to close in an LLC, maybe because you want to exercise certain tax strategies like cost segregation, depreciation, you won't have that option right out of the gate on a Fannie Mae second home mortgage. Now, beyond that, the most common product that is being used is the DSCR loan. Now, a DSCR loan stands for debt service coverage ratio. And with the DSCR loan, we're not looking at any of your income or your employment to underwrite that loan. Instead, we're looking at the subject property in a purchase transaction. We're looking at the subject property and we're determining what that rent potential might be. And then we give it a 20% haircut. So say it's $100,000 a year on the RABU estimated or annualized rent potential. We're going to give it a 20% haircut. And then now we have $80,000 to work with to qualify that purchase. Now, the question is, will that $80,000 divided by 12 cover the monthly payment on that mortgage, principal, interest, taxes, and insurance? And if it does, we're good. That's the whole purpose. It debt services, right? The property will debt service the mortgage. Now, some of the pros with the DSCR loan would be flexible terms. You're going to have, ARM products, you're going to have fixed rate products, and you're going to have interest only options. So if you're looking to get into a property and you want to maximize cash flow, you'd probably do a 7-year ARM with an interest only payment, right? That thus bringing down the payment to absolute lowest possible. Or if you're in a market where rates are really good and you feel like this is the time to secure a principal and interest payment, you can look at a 30-year term or even a 40-year amortization term on a DSCR loan, which is a very unique term, right? Stretching that payment over 40 years might get you into the numbers that you're looking for this investment. And you can close in an LLC. So that's another benefit of the DSCR loan. The cons of the DSCR loan is really going to be the interest rate's going to be slightly higher, and then you're going to have a prepayment penalty on that. And later, when we talk about strategy, I'm going to teach you and give you some suggestions on how you can navigate and negotiate your way out of that prepayment penalty. Now, the third option that's available out there to real estate investors, particularly for the self-employed real estate investor, is going to be a bank statement loan. Now, it's not uncommon for the self-employed individual to have tax returns that don't show enough income to qualify for that conventional or more traditional loan. So the bank statement loan works in the sense that we don't look at the tax returns of the self-employed individual. We're going to look at the last maybe 12 or 24 months of their bank statements from their business or personal account. And we're going to average the deposits or income into those bank statements over the last 12 months and use that as the income to underwrite the file. Now, when using a bank statement loan to purchase an investment property, we also get the added benefit of using the potential rental income from that subject property in that income calculation. Benefits of the bank statement loan, it's going to be a slightly lower rate than the DSCR loan, and it starts with a lesser prepayment penalty, right? And I'll put that into terms. A prepayment penalty on a DSCR loan typically starts at 5 years, but you can negotiate to 0. A bank statement loan starts with a prepayment penalty at 3 years. So the cost to negotiate from 3 years to 0 years is considerably less. And so those are the three products that are out there kind of serving all of the different types of STR investors, whether you're a full income doc qualifier, no income, no employment qualifying, or a self-employed individual looking to invest in real estate.